Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets.
Euro-dollar. A bearish harami yesterday, if only just, but also a bearish double pattern. It showed once again the market's reluctance to stay above the resistance of the 50% Fibonacci line of the January 21 to September 22 move at 109.44. Beyond this line in the sand is a congestion dating from late April to early May, stretching from this 50% Fibonacci line up to the interesting and influential neckline of the July 2017 to November 2018 move, currently at 110.88, and highlighted in dark blue on my daily chart. This neckline had capped the market in late April and May and allowed the construction of the mid-March to date bull channel. It's the one highlighted in bright red. Meanwhile, on the downside, we also have the market wary of testing the flatlining short medium moving average, currently at 108.78 once again. Further down, we have the ever so slowly rising medium moving average, currently at 108.17. Overall, we are still within the March to date bull channel, currently 106.78 to 111.45, which is highlighted in bright red on my daily chart. And so far today, an attempt lower, testing after all the short medium moving average, but immediately recoiling back up and looking like an indecisive doji cross right now. Cable, aka sterling against the US dollar. A very interesting bearish engulfing pattern and bearish opening black Morobozo yesterday. The market this time successfully punched down through the recent support of the interesting 50% Fibonacci line of the June 2016 to September 22 move at 126.99, plus just underneath the September 2020 low at 126.72. These original resistances that turned into supports have now become resistances again. They had capped the market back in early to mid-May and then acted as support these past couple of weeks, so they do appear significant. Further above, we have the overhead congestion combination made up from the November 2020 low at 128.52 plus the upper bull channel line currently at 128.92 and a powerful looking July 2021 to date optimized downtrend, which you can see angling down in dark blue on my daily chart, currently also at 128.92. These three resistances reached their narrowest and most powerful point today. So if there is to be an attempt higher, then it would need to be a really good attempt, or else wait until after this week's, as that is when the combination of forces overhead will have passed their zenith. Meanwhile, below we have the combination of the lower bull channel line, currently at 125.24, and the very slowly ascending short medium moving average, currently 125.33. So far today, a small dip lower, but within yesterday's range, and then a recovery, though still under the September 2020 low and the 50% Fibonacci line. Euro sterling. A third bullish white soldier yesterday and a continued follow-on higher to the recent indecisive spinning top that was also an in disguise bullish harami. In many ways, I suppose this is also a delayed reaction higher to last week's weekly key reversal up and a counter to the dead cross made earlier this week, which is a lagging indicator of the medium moving average, currently 87.41, down through the long moving average, currently 87.43. The move up made a new June high, but stopped short of testing the overhead April 2020 low at 86.69. In between the April 2020 low and the April 2021 high at 87.19, we have an area of congestion that was built up as a rectangle pattern halfway hesitation back in May. So far today, a little bit lower, but looking right now like an indecisive spinning top. We are still well within yesterday's range. US dollar against the Indian rupee. A bullish engulfing pattern and bullish opening white Morobozo yesterday. I suppose it was a follow-on high to the recent two-day homing pigeon pattern. Now this pattern is traditionally seen as a bullish reversal pattern. However, data indicates it acts as a bearish continuation pattern close to 6 out of 10 times. Well, it seems this time the market is following tradition rather than the data. It also falls in line with my suspicion that the market is building up a congestion area roughly between 81.90 to 8200. You can see this with the number of closes around this area and a few highs and lows in there over recent weeks. Looking overhead, we have the slowly rising long moving average, currently 82.14, Then the flatlining short medium moving average, currently 82.18, and above that, the slowly dipping medium moving average, currently at 82.24. Looking further below, we have an early May piece of closing based congestion between approximately 81.65 to 81.80. Overall, whilst we are still seemingly in a hesitation period after the pullback from testing the overhead broken since seemingly repaired upper time, currently 82.48 of the October 22 to January 23 mildly bullish, bit mildly bearish shift pitchfork, which is highlighted in dark green on my daily chart, this hesitation period may be coming towards an end. Separate to all this, another recent feature remains, and that's the recent bow tie formation of the short moving average, currently 82.12, short medium moving average and the medium moving averages. This triple crossover pattern set up the opportunity for a move higher, as all the moving averages went in and out of the bow tie in the right order, and were mainly pointing higher. Now, theory indicates that between 20 to 25 sessions after the crossover, we may see a move in the direction of the bow tie as a result. Thus, we are just past the period as it was between the 20th to the 27th of June, and so far there has not been any overwhelming move in either direction. So it's all been quite disappointing. We also have another pattern, an April to date potential roof pattern, highlighted in bright red on my daily chart. This is not an ideal pattern, but it's still there. Finally, we have the ascending triangle formed between January to March. I've been talking about this forever. Highlighted in dark blue. The market continues to have difficulties in interpreting this pattern. So far today, we're a lower open, followed by a straight move higher, but not far enough to test the long moving average, not just yet. And we're seeing prices dip back towards yesterday's close. US dollar against the Brazilian real. A second bullish white soldier yesterday, and a more than suitable follow-on higher to the previous session's immediate countering key reversal up and bullish engulfing pattern. It was a second consecutive close over the 50% Fibonacci line of the October 2018 to May 2020 move at 477.54, and potentially the start of a repair of the breached lower bear channel line, currently 481.15, highlighted in bright red on my daily chart, and that's of the November 22 to date bear channel. As prices actually opened right on the bear channel, lower bear channel line yesterday before heading higher. This breached trend line had acted as a cap on the market in one way or another. Last week and the week before, and that's when we saw those actions, so this is actually quite a significant move higher. And the move higher pierced the 50% Fibonacci line of the June 2019 to May 2020 move at 484.26, and the middle time, currently at 485.14, highlighted in dark blue on my daily chart, of the broken but seemingly repaired late July to late September 2022 bearish shift pitchfork. This pitchfork is important as it had showed the bearish angle of attack of this market way before the bear channel was created. We ended up closing right on the middle time. Now, I will continue to watch the action around the bear channel and now the middle time with interest, as sitting over all of this is still the shadow of the monthly key reversal down we saw in January, and now a possible monthly key reversal here for this month as well. So if we close on Friday night either above 505.75 or under 498.60, then we're beyond. Anything in between would have the lesser outside month instead, and at the moment we are looking very much like a monthly key reversal down. US dollar against the Mexican peso. A slightly lower, indecisive doji cross yesterday. The market is still hanging around the previously breached September 22 to date bear channel line, currently at 1707.80. Below, we are also testing a mess of supports made up from the core band of support between approximately 1703.90 and 1701.35, which has as its chief constituent the April 2016 low at 1703.89. Additionally, below that, we have a combination of the middle time, currently at 1689.17 of the December 22 to March 23 bearish Andrews pitchfork, which is highlighted in bright red on my daily chart. And that's supplemented by the lower trend line in dark green of the March to date descending wedge pattern, currently at 1686.15. The lower trend line, which for a while had been just below the middle time, is now mingling in with that lower trend, middle time. What all this does is show how this market is getting squeezed tighter and tighter between supports and resistances, and I have a strong suspicion something's going to give way, and in the not too distant future. So far today, well, a little more squeezing, what looks like a slightly higher indecisive doji cross right now.
Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.